we put together, similar to the past, some slides to maybe go into and look at the level of concentration in the market. And I think, if we start on this first one and look at the chart on the left, and a lot of folks probably are familiar with the top 10 and the level of concentration. And then this chart looks at the last 30 years. Market concentration really picked up in 2016. We were only in the high teens back then. When you look at the top 10, their price to earnings ratio was actually less than 14 times, below the other 490 stocks in the S&P 500. Post the COVID outbreak, the top 10 moved up to a 30% weighting, and you can see from the chart, and the P ratio expanded to 30 to 40 times. So again, excess moved up more than 2x in levels you hadn't seen going back to 1999-2000 time period. Top 10 underperformed, from late 2021 through the end of 22. And you saw concentration fall to mid-20s, P ratio contracted back to 20 times. And today, going through this history, because we're near back to record highs of concentration, the top 10 on a PE ratio is back above 30 times. Also, similar to 2021, the Mag 7's profit margins last quarter were back to 23.5%. So you're close to the peak levels you were late in 21. And, the final kind of comment on this first slide or first chart on the left would be, if you look at all the spending in AI infrastructure, the larger companies are actually becoming more capital intensive. And as you look at the percentage of revenue, the top 10 has actually climbed over 10%, and some are approaching 20% of revenue as far as CapEx. On the chart on the right, we're looked at valuation spreads. We've talked about how spreads in the past are wide versus history. This looks at price to sales looking back, 14 years. And as you can see, the most expensive decile all the way to the right, or the longest duration equities, are 2x 2010 levels, currently at 15 times. The lowest decile at the left, you haven't seen much change. And if you compare that decile to the most expensive or the average of the market, you would be near kind of historical lows, similar to kind of COVID, off the worst of where they were in COVID, but still not far from where you were in 2000 time period. And today, as we know, historically, companies greater than 10 times revenue, it's struggled to outperform the market over longer time periods. There's a lot of embedded expectations of growth continuing for a lengthy period of time. So any disappointment or timing of that would actually, as historically, led to multiple contraction. Today, nearly 20% of the S&P 500 are in companies with a price to sales over 10 times. And half of the Russell 1000 Growth Index it also has a weighting in those companies. So valuation expansion in long duration equities, it's a growing risk for passive. And investors, I think, in a lot of ways are probably missing out on how concentrated across different subclasses of the equity market. Because if you own the growth index and you own the S&P, you're actually getting 2x weighted in those same securities. On the next slide, while mega cap and growth outperformance could continue, again, we've seen valuations expand late 90s and go on longer than we thought they would be. But on the next slide, we highlight kind of what historical inflection points been for concentration. And if you think about the chart of the top 10% by size on a combined market cap, the top 10 are now back to kind of 60% of their highs, approaching 70% of the overall market. I don't know if, Liz, if you can turn to the next slide, that'd be great. If you look at going back historically, the last time we've been in a similar time of concentration would be 2000, 2006. And if you look at the chart on the right, from 2006, small cap value had cumulative returns of 185%. Large cap growth fell by 29%. So a 215% spread as the market broadened out. And it was also a great period for active investing when you go back to 2000 time period. So again, I think the setup here is for a similar potential cycle we look at over the next couple years. And on the last quarterly call that we had on July 11th, inflation numbers actually came in better and below expectations. The market started pricing in a Fed rate cut. And from that day through the end of the quarter, small cap was up 10%, large cap growth was down 2%. So you had a 12% spread on the later part of the quarter, which is similar to kind of 2026. So we expect the market to continue to broaden over time. There's a lot of mispriced investment opportunities we're going to talk about in a minute. And with lower valuations, especially within the small cap area. If you look at the next slide, we're focusing mainly just on small caps and looking at them relative large caps. The upper right looks at the red line is small cap returns versus large cap. And we're obviously back towards what you saw in the late 90s, 2000 time period before a cycle in which small cap outperformed for a lengthy period of time. The most recent rolling 5-year return, small cap versus large, is now in the 9th percentile. And with current outperformance, underperformance could continue. We see a growing list of items actually that would be check marks for kind of tailwinds for the next couple of years. First we'd highlight is when you've underperformed by this much, it's led to small cap outperforming high single digits over 1, 3, and 5-year time period. Relative valuations today are near 40-year lows between small and large cap. The bars in this chart would actually highlight the yield curve and the slope of the yield curve. So a higher bar would be a steeper yield curve. And so when the Feds cut rates, the slope of the curve has now gone positive. And the steepening of a yield curve has coincided with small cap outperforming. And it's also not uncommon for the 10-year to actually continue to normalize higher as the curve steepens, which could be a potential headwind for longer duration valuation multiples over time. And then finally, small cap are coming out of an earnings trough, an earnings recession for the last couple quarters, which we believe potentially sets up for relative earnings growth being faster in the next year or two. Final comment on the chart in the bottom is small cap as a percentage of the U.S. equity market, only 3.7%. It's actually smaller than some of the largest market caps in the market. And you have to find a similar time period. You have to go back to the early 1930s. And the long-term average is 2x the current weighting. So we continue to believe and see value stocks and small caps are under-owned, they're under-followed, and they provide, we think, significant market inefficiencies and attractive price to value gaps that could lead to kind of future outperformance. On the next slide, we're going to get into a couple of stock-specific comments. Before I start with Gray, just want to go back to and reiterate comments on the prior call. First on Lincoln, symbol is LNC, $31 a share. We continue to believe it's mispriced. Price to book is near Great Recession valuation levels. It's a 50% discount to forward book value. We believe book value is going to continue to grow sequentially every quarter. Forward P multiple is closing in at 4 times. It's a 25% earnings yield and nearly a 6% dividend yield. And marketplace fears appear to be more rear view mirror based. Past issues, management team is either fixed by delevering the balance sheet or in the process by improving cost reductions and a greater focus on free cash flow. Lincoln, appears positioned for a sell side upgrade cycle. 90% of coverage is a hold or sell rating. And returning to historical valuation multiples and achieving their 3 to 5 year targets would support a stock that's 3x current levels today over the next couple of years. And then second, most energy stocks have pulled back with oil prices. We talked about energy last quarter. We see market fears on greater OPEC supply is misled. Supply demand remains relatively tight and could easily be disrupted by the growing kind of Middle East geopolitical escalation. In addition, there appears to be low expectations for any improvement in China demand, which has been pulled back for the past couple of years. So if that was to come in better in the next couple of years, that would be more supportive also of prices. Oil, again, could always pull back near term unexpectedly, which could weigh on shares on the near term. But we think a lot of the equities today are pricing a much lower permanent environment. And Nabors, which we mentioned last quarter, symbol MBR, it's mispriced 1 times cash flow, 3.5 times EV to EBITDA. We think the upside potential there is multiples of where the share price is. For this quarter, the slide that you see currently on the screen is Gray Television. Symbol is GTN. The chart highlights stock price. It's a 75% discount to book. You have to go back to the Great Recession levels to find a similar time period or a similar valuation. The stock's lagged because of fears of a higher debt leverage. However, the fundamentals of the company are actually improving. If you turn on your TV, it's hard not to see political advertising. Basically, every hour, multiple ads. That's obviously ramping over the past couple of weeks. Sinclair Broadcasting just raised their political advertising expectations by 15%. Gray has captured historically the greatest political advertising market share through their number one, number two TV stations. Management's also renegotiating transmission agreements. That's going to be a positive, shifting from audience to audience reach from number of subscribers, which should help them also stabilize and return potentially to growth. And then finally, ATSC, this is a new next-gen TV. It's going to be rolling out IP-based, frees up spectrum for GPS services, and we think that's another positive that could bring incremental revenue to the industry. The shares look mispriced, market cap of 500 million. We think there's $2 billion of free cash flow over the next 5 years. Delevering the balance sheet should help the long-dated debt too. That looks severely mispriced in our opinion as they continue to reduce debt. And then the final chart, we want to highlight Quad Graphics. Quad's a little bit north of $5 a share, small cap printing company that's gone through a transformation to become a marketing experience company. This chart highlights some of the valuation multiples of this year and next. If you look at the company today, they have 1,500 employees that are on site, Fortune 500 clients, and they're assisting their chief marketing officers to get more efficient with their marketing budgets. And that's the big push of the transformation to build more of these higher margin services. The shares have been weak over the past year because large print has gone down with double-digit increases of postage. That should still be a near-term headwind, but we think as over time, these new marketing initiatives are going to continue to kind of have a positive mix shift, carrying higher margins in the business model. As you can see in the chart, 5 times earnings, 5 times for a P multiple in 2025. Majority of the cash flow is generated in the fourth quarter. So the next 6 quarters of free cash flow, plus sales proceeds from closing print facilities, those total proceeds are close to 80% of the current market cap. And the company is continuously going to be reducing debt. The EV to EBITDA multiple, even though here it has 3.16, it's actually, if they use all that free cash for debt reduction, it would be closer to 2.5 times. So the upside potential we think is sizable. R.R. Donnelley is a competitor. They were acquired for an EV EBITDA multiple of 6.8 a couple years ago. And if you look at marketing service companies today, where the business model is shifting, they're trading at 7 to 9 times. The company's having their first inaugural analyst meeting in November. So we think that's a potential catalyst as it's under followed by only 1 or 2 sell-side analysts today.